do that by? Was it 9 months?
9 months after the date of death, an estate tax return is required to be filed, but they can be extended. So you can file an extension, and it's due due when the return is due. So if it's on extension, legally on extension, you can get the extension period as well. Question?
And for states that have an estate tax, there's plenty that don't have portability laws, right?
Yes.
Maryland.
Maryland does not have portability. Maryland has an estate tax on anything over $2 million per person right now. It's scheduled to go up to the federal exemption level by 2019, but it's ramping up. DC does not have portability. DC's exemption is 1 million. Although the city council voted to increase it to the federal exemption level because they also voted to legalize marijuana, the federal government prevented them from increasing their exemption. So, is planning still relevant? Yeah. Particularly this year with these 2704 regulations that were just passed. I'll show you why in a second. But with a new president and a potential change in the Congress at any given point in time, yes, the estate tax laws are always going to be changing. The income tax laws are going to be changing. We have an opportunity to do some planning before year end for our large clients or our complex clients. The question is, do we have enough time? We're going to be running out of time. I'm already booked through November with all the stuff I've got. But we have other lawyers here who can help. So if you have clients who are over 10.9 million who need additional planning, come see us and we'll get them set up. But they need to come in the next 30 days because I'm telling you, there's a rush to do something now. Now, it doesn't mean we have to do something before the end of the year, but the ability to use valuation discounts will disappear after December 31, or maybe later. We may have a window of time that may take us into March or April, depending on when the IRS actually comes out with their final regulations. Because there's going to be a lot of comments that come in on December the 1st when the comments are due. I'll get to that in a second.
They wouldn't grandfather.
There is a huge
When I
question.
say grandfather, they won't go back and say.
There is a huge question on that.
That's
We don't. I'll get to that in a second on the 2704 regulations. There's a new 3-year rule that's in the proposed regulations, which is creating a lot of anxiety in estate planners and in wealthy individuals who want to take advantage of these rules. But basic strategies, irrevocable life insurance trusts still are very valid. They allow us to shelter from income tax and estate tax and from creditors' assets in a separate trust for the benefit of our beneficiaries. We can have spousal lifetime access trusts. So if we're building up cash surrender value in a life insurance trust, our spouse may be able to get access to it, and our kids definitely will be able to get access to it if they're beneficiaries of the trust. Ways of structure. Grant or retained annuity trusts, still popular, will continue even after these regulations come into effect. Qualified personal residence trusts actually will become more prevalent because of these new regulations. I'll explain that. And LLCs, using family LLCs as holding companies, that's going to be affected by these new regulations. Irrevocable life insurance trust, you create an irrevocable trust. You gift amounts into the trust to pay the life insurance premiums every year, and you have to follow certain formalities, including sending crummy letters out to the beneficiaries. They're not crummy, they're just based on a court case that came out in 1969. To allow the gift to qualify for the annual gift tax exclusion. We have to do that. If we don't do it and then we're audited or we don't do it right, all the premiums that were previously excluded will be credited towards your lifetime exemption. That's not good. The trustee of the trust actually signs the contract for the life insurance, signs a lot of things. I currently serve as a trustee of 56 life insurance trusts. We administer them here. We have a paralegal. She does all of that for us, and I make sure that the clients are looking at the policies periodically to make sure that the policies are the right policies to hold in the trust. As I mentioned, it's excluded from estate tax and income tax. So we can avoid the taxability, we can provide asset protection. It's a great technique. And it can be used to provide liquidity to pay estate tax. That's one of the main reasons that wealthy clients use these trusts. Either they get survivorship insurance, or they'll insure one or the other spouse, or they may set up two separate trusts, one with insurance on one spouse and one with insurance on another spouse. Caution, if you have these trusts set up so that the spouse can get access to the trust, and you have spousal access trusts, one for each spouse set up, there's a doctrine called the reciprocal trust doctrine, where the IRS will come in and look at these trusts, and if they're identical, they'll drag all of the proceeds back into the estate of the decedent. So you want the trusts to look different. We're involved in doing that for a client right now. We had to decant one trust into another trust and create a whole new set of parameters within the ability to do that. You can fix irrevocable trusts that are screwed up. But if they look exactly the same like your revocable trusts do, then we have a problem. And we want to do something about it. Also, it provides wealth replacement for charitable giving. Now, Cuperts are a cool way of transferring a house, a residence, or a vacation home into a trust for a period of years. You get to use it for that period of years, rent-free. You've already gifted ownership of the trust, of the asset to the trust. And the trust is for the benefit of your kids. So after the term is over, it goes to your kids, or a trust for the benefit of your kids. You say, what the heck? I still may be alive. Well, that's good, because it's out of your estate at that point in time. And we've done a gift tax calculation that's based only on the term that you have the ability to use that property. So the gift is the gift of the remainder that goes to the beneficiaries, okay? So we get to discount the asset, and if we give a tenancy in common interest in the property, piece of the property, like 30% to the trust or something like that, we can actually get further discounts. And these valuation rules don't affect it. So we're not adversely impacted by it. So Cupert is a pretty cool way, but you have to be willing to part with ownership of the property. It works really well with vacation homes, with second homes or third homes. With your primary residence, I'm in debate with somebody who's very well known, who's in the media. And he owns a massive piece of property locally. And we were talking about using one of these Cuperts. He doesn't want to give control to his kids, even though he's 87 years old. Just doesn't want to do it. We'll do something else. But there are ways of structuring Cupert to make it beneficial.
2704 won't impact.
2704 does not impact Cuperts. Cupert's under a different statute. 2704, the statute, deals with gifts or transfers of interests in entities, not business entities. That's another misconception. It doesn't just deal with businesses. It can be an investment LLC, right? Grant retained annuity trusts. I'm going to skip over this so we have some time to focus on an example and the valuation discount issue, because it's really important. Family LLCs, family limited partnerships, I've been using these heavily for the last 20 years. We set up a holding company. We contribute assets into the holding company. The father or the mother or the parents or the grandparents or whatever control that entity. We use a trust or trusts to own minority interests, or even ultimately acquire a majority interest cumulatively in that entity. We can get valuation discounts for transfers to these trusts under current law. And any growth and appreciation after the date of transfer is out of the estate. The downside of using this is that you don't get a basis step up for any assets that you put into the trust during lifetime, or that you just gave to your kids during lifetime. So they inherit your basis, your tax basis. so that when assets are sold or when they sell their interest, there's going to be capital gain or potential ordinary income on it. So there's a downside to that. So the key to doing this is valuation discounts are really important, or getting low valuations on the assets that you're using to fund these vehicles are really, really important. The valuation is important. Getting an appraiser involved is absolutely critical unless you're dealing with, even if you're dealing with marketable securities inside the LLC, you want an appraiser to value the limited liability company or limited partnership interest that's being transferred, because it is valued not just based on the percentage, but it may be subject to a discount because of lack of control, lack of marketability under current law. It also provides tremendous asset protection. It's another layer of asset protection. Remember we were looking at single member LLCs? Well, this is a multi-member LLC. For a creditor of one of the kids who's a beneficiary of one of these trusts, which owns one of these LLCs, to get at the LLC, impossible. It's impossible unless you're ignoring formalities and you're using it as a personal pocketbook. But if you're observing the formalities of the LLC, separate bank accounts, separate assets, you'll be protected. Kids will be protected from themselves and from their creditors. It's a great asset protection.